Hello trader, welcome back to my YouTube channel. In this video going through our engulfing trading strategy and depth, and how use in combination with price action. If you want videos more often, please smash the like button, subscribe and turn on the notification bell, so that you know content is released. Very important point before we start: everything we discuss in this video can be used for currency trading, stock trading and crypto, because price action stays relatively consistent across different assets. So we are going to go very depth in this. The engulfing trading strategy will give you the skill need to become a better trader. Through this guide I am going to take a deeper look into what exactly is the engulfing pattern, and how understanding this particular pattern can be improve your outcomes and trader. Furthermore, I am going to show you how to master the engulfing bar trading strategy with simple twist. Don't worry if you already know how engulfing trading works, we have some additional information for you as well. This will strengthen your existing knowledge about the engulfing candle trading strategy and help you find opportunities succeed as trader. Now, what is the engulfing pattern? Engulfing candles tend to signal a reversal of the current in the market. This specific pattern involves two candles, with the latter candle engulfs the entire body of the candle before it holds off. An engulfing bar is technically valid if it engulfs just the immediate bar prior to it. Note that the more prior bar that this bar engulfs, the stronger it gets. Types of engulfing patterns. There are two engulfing candles pattern: bullish engulfing and bearish engulfing pattern. First, bullish engulfing pattern. The patterns involves two candles, with the second candle completely engulfing the body the previous down candle. Interpretation: price action must show a clear downtrend when the bullish pattern appears. The large bullish candles show that buyers are piling into the market aggressively, and this provides the initial boost for further upward momentum. Trader will then look for confirmation that the trend is indeed turning around by making of indicators, key level of support and resistance, and subsequent price actions after the engulfing pattern. Second, bearish engulfing pattern. The bearish engulfing pattern is simply the opposite of the bullish pattern. The bearish engulfing candle triggers a reversal of an existing trend as more sellers enter the market and drive prices down. Further, the pattern involves two candles, with second candle completely engulfing the body of the previous up candle. Interpretation: price action must show a clear uptrend when the bearish pattern appears. The large bearish candles shows that sellers are piling into the market aggressively, and this provides the initial buyers for further downward momentum. Traders will then look for confirmations trend is need turning around by making use of indicators levels of support and resistance. Subsequent price action that occurs after the engulfing pattern. And now, how to trade engulfing pattern. Engulfing candles don't always have to appear at the end of a trend when viewed within a strong trend. Traders can glean information from the candle's pattern, pointing toward continued momentum in the direction of existing trend. In this video I will give you easy 4-step process to trade engulfing pattern. Let's get started. Step 1. Isolate the trend. The first step in applying the engulfing candle trading strategy is to dominant trend direction, and thus the directions you will trade in uptrend is defined by higher swinging high and higher swing lows in price. Prices moves in waves, advancing, pulling back, and then advancing again. In an uptrend, the advancing waves are larger than the pullback lower, creating overall progress higher. During an uptrend you should take only long position, buying with the intention of selling later at higher price. The downtrend is defined by lower swing lows and lower swinging highs in price. In downtrend the declining waves are larger than the pullbacks higher, creating overall progress lower. During a downtrend you should take only short positions, selling a borrowed assets with the intention of buying and returning it later a lower price. Step 2. Watch for an upward or downward pullback. Once the trend is established, wait for pullback. If there is no trend or it is unclear, don't utilize this strategy. Waiting for pullback means you are getting advantageous pricing for the next wave of the trend when and if it unfolds. If the trend is down, watch for an upward pullback. The pullback should really above the high of the prior pullback, as this violates the rules of a downtrend. And if the trend is up, watches for a downtrend pullback. The pullback should not drop below the low of the prior pullback, as this violates the rules of an uptrend. The pullback should be composed at the least 2 price movements, indicating the price has actually corrected. Corrected pullbacks may move in the opposite directions of the trend or may just move sideways. Step 3. Entering the trade with the trend isolated and a pullback occurring. Wait for the engulfing candle strategy. Trade signal. During downtrend, wait until a down candle engulfs an up candles. For an engulfing candle strategy signals during an uptrend, wait until an up candle engulfs a down candle. The most practical and widely used way to trade these bars is to simply place a pending entry order a few pips above the high of a bullish engulfing bar and a few pips below the low of bearish engulfing bar. Once a trade is initiated using the engulfing candles strategy, the safest position for a stop loss is a few pips above the recent swing high for short positions and below the recent swing for long positions. Step 4. Existing the trade. The engulfing candle that occurs after a pullback in an overall trend is designed to get into trade as the next wave of the trend is likely to unfold. However, it doesn't always. Trends can persist for a long time or can fail quickly. This method does not have a specific exit. The rule of thumb is to make sure your winners are at least 2 times as big as your losers. 5 times bigger is even better. Therefore, measure the distance between your entry point and where you place the stop loss. For example, if it is 40 cents, that is your risk. Your target price should be least 2 times greater than that, or 80 cents. Therefore, hold the trade for at least a 80-cent gain to compensate yourself for the risk you have taken. If the trend threatens to reverse by making a higher high and higher low during a downtrend and short trade, or by making a lower high and lower low during an uptrend and long trade, exist the trade. Cautionary notes. The thing that trading the engulfing pattern is bad idea was that we didn't have enough profit margins. Here is the example. Second, the engulfing pattern won't occur after every pullback, which means potentially missed opportunities. To help avoid this, consider allowing multiple candles to create an engulfing pattern. For example, if after a pullback in an uptrend it takes 2 candles to engulf the prior down candle, consider this valid signals of a shift in momentum back in the trending direction. Third, an engulfing candle strategy signals to us mean the trend will always resume. That is why a stop loss is mandatory. As always, if you learned something new, make sure you subscribe, click the notification and leave us like. Show your support. See you next.